Markets are now clearly turning their attention to the prospect of a Fed tightening in December, and indeed for 2016, the extent of any Fed tightening phase is likely to be at the forefront of most investors' minds. The San Francisco Fed paper just recently, and in fact a model developed over 10 years ago by LaBouche and Williams, estimates the neutral or equilibrium or the natural rate of interest at the moment at around about negative 0.2 in real terms, which amounts to about a 1.25% nominal neutral Fed funds rate. So the current Fed is about 100 basis points, 125 basis points below what is considered on this model at least to be neutral. So that's a benchmark we think for markets to begin to price in. Now how quickly we get there is difficult to say, but what is interesting in this model and is how it changes. The Fed fund or the natural rate of interest or the neutral equilibrium rate changes over time. It was once back in the 1990s, first half of 2000s, around about 4 to 4.5% was deemed to be the neutral nominal Fed funds rate. And you can see here that during the GFC and post GFC, it's basically dropped to around about 1.5% and essentially stayed there. Now, the neutral rate is essentially that rate at which medium to longer term inflation or deflationary pressures are non-existent. So the economy is in line with its potential and its potential growth rate. So clearly what we see at the moment is that for whatever reason, whether it be lower trend growth, lower population growth, productivity growth, lack of investment, the overall neutral real rate is very low. So I want to turn our attention now to the current situation and look at past Fed tightening phases. So you see here on this chart, we've got the Fed funds rate and we've highlighted the regimes of Fed tightening. So since the early 80s, I've excluded the 1981 period, 83, we've got 1, 2, 3, 4, 5, 6, 6 tightening phases. One that stands out, of course, and we'll have a look at this in a little bit more detail later on, is 97, where we had one tightening, and that was then aborted, that tightening phase, which is interesting to look at. But 5 of the 6, we had extended tightening phases. In these previous tightening phases, as you can see here, they lasted anywhere from around about 11 months through to a little bit over 2 years. Of course, there was also, as I mentioned, that 1997 where there was one tightening. But essentially, the tightening has amounted to somewhere around about over a 12-month period from as little as 50 basis points accumulated through to almost 250 basis points. And then, of course, over a 2-year period, the tightening has amounted to around about 350 to 400 basis points. But what has happened, or what have been the shape of the other indicators at the time of tightening? I want to first have a look at, for example, the unemployment rate. If we just look at that now in original terms, so what we're showing is at the beginning of these tightening phases where unemployment rates were at that point in time. So the current unemployment rate sitting at 5% is certainly well down on previous beginning of tightening phases. Also, we can see initial claims for unemployment insurance, another measure of labour market tightness. Typically, if we exclude 83, typically it's been below, say, 350,000. We are currently running at a rate of around about 270,000. So the labour market indicators are very much in line with previous experience of tightening. If we look at sort of real GDP, and I'm looking at 6-month annualised growth in GDP, we've seen at the beginning of previous tightening periods, GDP has been basically 2.6, 2.7 or higher. And where are we at the moment? Well, we're there or thereabouts. As you can see, the most recent 6-month rate is around about that 2.5% level. Just stepping through a couple of other indicators, and wages gets a lot of mention and focus these days in the sense that it hasn't been very high. Well, if we look at historically, average hourly earnings have been about 2.5, 2.6 or higher at the beginning of tightening phases. We are currently now sitting at around about that level once again, as you can see here. And average weekly earnings, likewise 2.6 or higher. And the latest number had us jumping up a little bit on a 6-month basis anyway to around about 3%. Finally, just on the inflation numbers leading into previous tightenings, core inflation, again, I'm looking at 6-month annualized. Core inflation has generally been 2 or higher. It dipped down briefly in 99, but you can see there that it's generally been above the 2% level. Where are we at the moment? Well, 6-month core CPI had sort of picked up in recent times to somewhere around about 2%, maybe a little bit more. So essentially what we would come to the conclusion is that most of the indicators are very close or thereabouts in terms of beginning of tightening cycles. Next, I want to have a look at what's happened to some various asset classes around or during the Fed tightening phases. So looking at the US equity market now, and we're looking at the performance in during those tightening regimes. So you can see here, this is US equities total return index. Essentially, in the first few months, it's very, very mixed. It's sort of fairly flat, and actually leading into the first tightening has generally been flat to slightly down. But in the 3 to 6 month period post the first tightening, generally the market has done reasonably well. You can see on all these occasions been up by anywhere between 5 to as much as 15%, but then it's tended to fall away in the following 3 to 6 months. Certainly 87 with the 87 crash was significant, but it also fell away on a number of other occasions, as you can see there. But certainly the 3 or the 3 to 6 month period has generally been fairly positive for equities. Turning our attention to some of the other interesting assets, I want to have a look at the US dollar. There's a lot of focus on the US dollar and expectations of US dollar strength at the moment. But if we look at I'm looking at the US real effective exchange rate. What we've seen in the past is, except for the 83 rally in the US dollar, by and large, it's been flat to down, certainly over a sort of a 3 to 6 month period, which is sort of probably runs counter to what the expectations have been. So the US dollar has tended to be flat to down in 1, 2, 3, 4 of those occasions, and up once strongly, and then of course the 97, which is only a very, very brief period. So US dollar weakness rather than strength has in fact occurred. And finally, I want to look at emerging markets. This is another asset class that's quite a lot of negativity around at the moment. Emerging markets, I'm looking at in local currency terms, and we're only starting in the 1990s, but you can see here on each of these occasions it's rallied quite strongly, in fact somewhere around about 20 to 25% in that first 6 month period, and then started to fall away after that. And finally, what's happened to bond yields during these tightening phases? Well, as one might expect, generally bond yields have been rising. So I'm looking at the 2-year Treasury, and in terms of basis point moves, you can see there, outside of the 2004 experience, at least initially, bond yields, 2-year bond yields have risen on an average, by average of about 150 basis points, a low end of 70 to 80 up to as much as 300 basis points over a 12-month period. Going out to the 10-year, once again, very similar, although in 2004 tightening phase, the first 12 months, they were actually flat to down, but on all other occasions, around about 100 basis points to as much as 300 in the early 80s. So generally been bad for bond markets as well. I think we need to look a little bit more closely at what was going on in those 5 of those 6 Fed tightening phases that we've spent some time looking at, and the implications that that's had for various asset classes. As you can see here, this is world GDP, the IMF measure of world GDP, and you can see on each of these occasions, global growth has been essentially in excess of 3.5%, upwards towards 4 or even higher in the 1980s. So here we are at the moment sitting with growth of a little bit over 3%, possibly going up to 3.5, 3.6% next year. It's not exactly the sort of environment that has occurred in previous Fed tightening phases. And then finally, and related to this, I guess, is what's been happening to commodity prices. So in each of those tightening phases, now we're looking at the performance of commodity prices, and you can see here generally they've been up, although again 2004 they were fairly flat. and to some degree in 99, 2000, but by and large they've been flat to quite a bit stronger. So again, you've got to ask yourself, is this the sort of backdrop, strong growth, rising commodity prices, that will be associated with this Fed tightening phase, or is it does it have more similarities potentially to the 1997 aborted cycle, which we'll now discuss? So why was there only one tightening in 97 and why was it aborted? So if we go back here, you can see the chart here, there's the Fed funds rate. So there's the dot representing the beginning of the 97 tightening cycle. Why did we only have one tightening? What was happening to the economic factors or key indicators that we looked at earlier on? Certainly if you look at the unemployment rate, here, you can see that the unemployment rate was around about 5.25% on its way, mind you, to 4% or below 4%. So it was at very low levels, what might have been considered very close to full employment. Perhaps around that time, the Fed was in fact thinking that Nehru was actually a lot lower, and they would have been encouraged by what actually occurred during the late 1990s. But unemployment was very low. We can now run through and have a look at, say, for example, wages. Wages growth, average hourly earnings were growing at around about 3.8%, so they were very strong. Average weekly earnings were growing at around about 4%, so unemployment was low, the labour market was tight, wages were rising, and inflation was around about 2%, as you can see here. So all the conditions were in place for an ongoing tightening cycle. Why was it aborted is probably the more interesting question, and are there any sort of similarities with today's potential for a tightening phase? So despite running a fairly hot domestic economy, as we just saw, with growth, wages growth quite high, the labour market quite tight, the US Fed put in place one tightening and then aborted that. What they were helped by, of course, was the decline in commodity prices, which in itself was a reflection of the Asian crisis, which was unfolding around about that time. So the CRB, for example, we can see here the CRB fell from a level of around about 300 down to 220 over the course of the next few years. Import prices into the US, the index fell. If we look at that, we can see that it's certainly over a 12-month period down 10%. It fell more than that. So they had a situation where, despite strong growth, tight labour markets, declining commodity prices allowed inflation to actually fall from 2 to, this is the 6-month annualised PCE price index, down to about 0.5% over the coming 12 to 18 months. So perfect conditions, and of course this allowed the US equity market to perform quite strongly. We could just find the total returns index there. So you can see here, this was really the beginning of a very strong run in the equity market. So a relatively strong economy, yet little or in fact declining inflation rates allowed the Fed to stay on hold, despite what typically they may have been forced to be actually tightening policy, and perhaps we would not have got quite the rally in equity markets. So why do I bring this up? I guess this is the period that's different from the other 5 tightening phases, where equity markets did okay, bond yields rose, but it occurred in a backdrop of strong global growth and generally rising commodity prices. 1997 was quite different in the sense that it was only one tightening, and largely because of inflation being well contained due to global pressures as opposed to domestic pressures.